Thanks very much for all of you joining. Today we will, as Raymond already indicated, we will talk about good corporate tax citizenship. What does it really mean, and what can we learn from how governments and financial institutions have done so far, a little bit ahead of the curve, as well as the mining companies we will be addressing in that slot. So with that, I would like to go to the next slide and take you through a couple of what I call a balancing act between transparency and social responsibility. But as you will learn from following slides, also a balancing act between transparency and privacy, transparency and confidentiality, especially on the business model you're running. So the tax authorities have already at an earlier stage, or the governments in particular, have been looking at financial institutions, and the big question is, why is financial institutions being treated differently? I think from two angles. One angle is the financial institutions do carry a lot of bank transactions through their books, which obviously give the bank as an intermediate, in this case, give tax authorities a host of intelligence on tax positions to be taken not only towards the bank, but also towards the clients of the bank. And a second approach is because the banks are heavily regulated, so that there is an implicit connect between a license to operate and behaving according to the rules which fit into this license. So if you look at, for example, New Zealand, there's a bank disclosure statement where various information on credit rating, profitability, total assets, capital adequacy, etc., is being reported. In Singapore, it even goes one step further, and it asks to also publish everything in the local daily newspapers. The EU has taken up this what is called a sectoral country-by-country report, and has linked it to a capital requirements directive, so to basically the license to operate a bank and the protection of the clients of the bank. And this includes a country-by-country information where names, nature of activities, geographical locations, turnover, number of employees, profit and loss, tax paid, and subsidies received is sort of part of the equation of what banks already are reporting. And again, let me make this clear, this is a public reporting to the market. So there's no hiding from that perspective. So the next slide, we go to that. And apologies for me not translating everything from Dutch into English, but I think most people get the view of this. This is the view how the central bank in the Netherlands looks at the clients of a bank, and especially the risk factors, and it's called a heat map, tax integrity risk. So in this scenario, the central bank says, well, banks are a special breed and should be very transparent, in this particular case as an intermediate, and should share the caretaker function for bringing the right tax home on behalf of the government. And how does that work? Well, each of the banks in Holland has to report a special scan on certain type of clients, and what certain type of clients and profiles are they looking for. They're looking for the following sectors: oil and gas, commodities, real estate, retail, transport, energy, mining, and infrastructure. So this is where they say, okay, banks, anything there, we want you to be, as an intermediate, very transparent and very much know your customer type of organized, because that will also have an impact on the license you operate under. Then in jurisdictions perspective, they say anything which moves to countries with a confidentiality clause, anything which is perceived to be tax holidays, location like VVIs, Cayman Islands, Panama, UK, and other countries, is on a higher risk profile. So if you do have clients in these territories, please watch out for this. This is a paper they've written and updated various times. So this is still very much how central banks look at. The central bank is looking at the Dutch banks products. Anything on clearing, project finance, UBO financing, mortgages, corporate credits, markets, and payment accounts is the typical products where they say you need to see whether the tax rules have been fully complied with. And then the type of clients, LLCs, LLPs, foundations, trust clients, offshore UBOs, retail, stacks. So here you see how the central bank looks at, and the central bank is the one who hands out the license to the local banks and can withdraw it, is looking at the bank and the role of the bank as an intermediate towards transparency on things like that. And this is they call it a tax integrity risk analysis, but it's another way from a central bank perspective to look at tax leakages. Let's move on to the next slide. So what are we looking for when it comes to disclosing information, and how transparent are banks compared to other entities in other sectors? As I think most of you online will have taken notice of the country-by-country reporting, which is the Action 13 BAPS, one of the documents. It typically discloses wherever we put a tick the box on. So it gives you quite a good data set of the value chain of the multinational. Then if we take it a little bit further, there's a European Commission proposal for public country-by-country reporting, which does have a little bit less information, but again, it is public, so it is so far. I believe it has not made it to a full implementation, but I would not exclude this time will come sooner rather than later. Then we're looking at the banks. We just have taken as a starting point, because the banks have, under this capital directive, been imposed already a country-by-country reporting much earlier in the game than any of the other companies, for the reasons I just shared with you. So here you see a little bit what I already phrased, what they have to disclose to the public domain. So this is also public country-by-country reporting. Then there's two additional initiatives. One is the EU Accounting Directive, and the other is the Dodd-Frank Act. They basically look mostly at infrastructural and mining companies and oil and gas companies, and how their interaction with governments looks, and they want in this reporting, they want a full transparency, even at a project name and project level, and what is the receiving government of the services. So it's basically call it an anti-bribe, anti-money laundering, any anti-corruption set of reporting the authorities have been putting in place. There's one initiative which is not on here, but we get to that in a while. There's the Extractive Industries Transparency Initiative. So that is the mining companies who took right after the country by country public CBCR was being introduced for financial institutions. The extractive industry took an own initiative to report certain positions on tax and their value chain in the public domain as well. So if you look at this accumulation of reporting standards, it becomes pretty obvious that as we were talking the last two sessions, that CBCR is really like a fishing expedition. If you're in certain industries, all these tick the boxes do move a lot of data to the government. And is the government always very integrated on receiving those data points? I don't think so, but it gives you, if governments are smart and are connecting the dots on all of this reporting, obviously it makes them a little bit smarter on basically running a value chain, a data analysis on all of the enterprise, its operation. The difference between undisclosed and public CBCR is also kind of a challenge, because why, say you're a subcontractor to IKEA, why would you like to be transparent on reporting a public CBCR to the marketplace, where a lot of outsiders, but also insiders, like if IKEA is your principal, can see what margin you're actually making on that type of business. So there's a lot of commercial secrets, I think, which are at stake, which is one of the reasons, just one of the many, to not be maybe 100% fully transparent. So the country by country reporting, and this is focused on the EU on the first, but as you know, this is the OECD member countries as well as inclusive members who have applied to country by country reporting thresholds of 750 million. I think we're now before the end of 2020, we have run the 16, 17, and the 18 and 19 CBCR. If you're already doing this since the beginning of the BEPS reports and the implementation of CBCR. So the expectation is that country by country reporting might actually go in the direction of also a lower threshold in the coming years. What we see happening now is that countries are analyzing the CBCR, are doing 1 year, 3 years, or even soon 4 years outlier analysis on this country by country reporting. The initiative the EU took on a public country by country reporting was 750, but there were in the European Parliament, there were propositions to move that country by country public version down to a threshold of consolidated sales of a multinational up beyond and in excess of 40 million euros, so 40, which obviously is a lot less, and that would immediately draw much more companies into having to do a public CBCR. The capital directive we already talked about, and as I said, the EU accounting directive and the Dodd-Frank is really in the exploration natural gas type of angle, where the disclosure is very much a government related issue in that type of industries. They want to make sure the relationship between these bigger companies and the governments are straight and transparent of nature, and there's enough reporting on it to keep it sound and safe. So this is the ones who get impacted by all of this. If we move to the next slide, this is a little bit the driver, and this comes from a Q&A memo which was published in 2016. Basically, there's next to what we saw, the central bank has an interest to get all that information, tax related, more looking at the bank as an intermediate to collect all that data. Second, the governments in general, but the tax authorities in specific would require that information. If we look at the multiple stakeholders analysis, this shareholders rights directive, the European Parliament has been introducing the public country-by-country reporting within the context of the shareholders should get the full insight into the company they invest into. So here is a shareholder's perspective, and this amendment to make it a public CBCR, as this indicates, sought to extend to all industries beyond the banks who already are publishing. So this is just changing the name of the game, the breadth of the game at the same time. By the way, if you're a bank, it doesn't necessarily mean you're always relieved from filing your CBCR. So that whole question about reporting and double reporting certainly is an issue to look into. Although in a lot of the CBCR proposals, especially the ones by the OECD, there's always a special place and sometimes a special set of exceptions granted to financial institutions and the extractive industry. And this is sort of where I just gave you the reasons why sometimes these industries are not put up with a double compliance exercise. So what was the effect of such a public CBCR around 14 being introduced? And how could the impacts like reputational costs, tax audit scrutiny, and regulatory scrutiny be measured? So I just took one academic paper from March this year, which measured in very simple terms the tax haven entities banks had compared to the total entities. And it used insurance companies who were not under this set of public CBCR reporting as the peer group to measure against. And what you see happening here is the first impact, because it doesn't, the academic study doesn't go all the way to more recent years, but the initial response of most of the academic papers is once we introduced the public CBCR, banks started cleaning up their legal structure, especially the legal structure in tax havens, tax haven entities. The number of tax haven entities was significantly reduced. Does that mean there's no tax haven entities left? Well, no, but it's sort of the first, what this article calls real effects of a public CBCR and the impact of that, especially looking in this case at the European banks. Kuntal, any comments on this public CBCR, and especially also if you look at the enormous transparency drive India is going through with the government really pushing hard on full transparency? Any observations from your side?
Yeah, thank you, Steph, for this opportunity. And yes, you are right. The government of India has been really pushing the transparency agenda very hard in recent times. And specifically, if we were to talk from the point of view of financial institutions, I think one will have to also keep in the background the other non-tax regulations which are applicable to Indian financial institutions. Because one is that recently, for past few years, there has been a sense of realization by the authorities as well as the stakeholders in the Indian financial sector that the banks and the other financial institutions are very much facing the problem of non-performing assets very badly and very hardly. And that was seen as a very big major problem for Indian financial sector as a whole. And it was seen that for decades, the issue of non-performing assets faced by the financial institutions was kept under the carpet. And
Mhm.
even though there were some regulatory measures, it didn't give the desired impact to clean up the system and also bring the defaulters on the books.
So
Uh,
that's a transparency from a solvency perspective.
Solvency purpose,
Yeah.
right? And yeah, and the very major step in that direction was introduction of a new insolvency and bankruptcy code a couple of years back by Indian government. And what we have seen as a real impact effect of that regulation is that there are so many defaulters who have been now compulsorily made to either go through a resolution exercise or they've been made to go through liquidation, which is having impact on liquidity and on the financial sector on a short-term basis. But it is felt that in long term, it is going to be of a great advantage to the Indian financial sector as a whole.
Yeah.
Keeping Yeah, and keeping that one point aside, if you also see now there are many regulators involved into Indian business environment and in economic environment. We got central bank which is regularly monitoring the capital adequacy norms and the standard of disclosure by the banks as well as financial institutions. We've got Central Security Commission, which is also very vigilant, very active when it comes to disclosure of the information to protect the interests of the shareholders. We've also got Insurance Regulatory Authority in India, which would govern the operations of the insurance companies. And this is a very, very interesting graph which we have placed on the slide here, where it is bringing out that the insurance sector, which is not as seen closely by the regulators as much as by the banks, are probably providing some alternative measures for people to perhaps not comply with the laws fully, or perhaps try and avoid the disclosure of their offshore assets. And this
Well,
is something.
that's a too harsh statement, I would say, on this limited graph. So I think we should watch
Sure.
there's some limitations to this. Is there a public CBCR in India introduced as well as the one I'm going to?
Yes,
Uh,
so India is part of this BEPS whole measures, and India is part of inclusive framework. CBCR is now part of Indian domestic law, and the threshold which you have prescribed in your slides are also applicable when it comes to complying with CBCR norms in India.
okay.
India has also entered into many exchange of information arrangement with many countries, many offshore territories. So practically the exchange of information happens on automatic basis. There is absolute transparency with regard to having the access to the assets and accounts of Indian residents outside of India, as well as of the foreign citizens having accounts at India. So you are absolutely right. Transparency has been is the keyword which government has been following in the recent past, and we are seeing the result of it. And the compliances are going up, and the digitalization of the whole tax system is also playing a very important role to ensure that people have a right and accurate disclosure of financial statements. And one very important indicator of this would be that if we look at the effective tax rates of say top 10, 15 listed companies in India, you'll be surprised to see that their effective tax rate is more than 34%.
Okay.
So that's the kind of effect which it has on tax compliance and disclosure by all the companies in India, especially for banking institutions.
Okay, very good. Just to showcase one country snapshot from the 2019 public CBCR, Barclays published, and this list goes on and on and on. So we put the hyperlink there. This is kind of an interesting tension you feel when you read only the UK, where the way Barclays is explaining, we're one of the largest banks in the UK, and they explain what profits they are reporting in this table. It includes, for example, dividends received from overseas subsidiaries. And then right in the middle, it says in 2019, we paid no UK corporation tax. And why is that? They explained there's contribution to pension funds and other contributions, which basically were reducing the taxable base downwards. So what this kind of information says is fairly detailed and goes what we initially thought when you looked at the variables in the table I showed to you before. It looked like the number of ticks and the CBCR was a lot more ticks than the undisclosed CBCR was a lot more ticks than the public CBCR. But here is an example where if you look at this public domain CBCR, you suddenly see a lot of tension coming your way on being fully transparent. And maybe I would like to invite Luis, if he's able to unmute, to share his views on this type of public CBCR reporting by banks.
Thank you, Steve. Thank you. I was reading this information by Barclays, and I found it quite interesting to see the dangers you have when you disclose part of information but not whole of information. Danger for your image. Just imagine that you show that you have profits but you're not paying taxes, and you must explain this and explain it very well. I was not aware of this information by Barclays, so this was the first time I saw it was in these slides here. But it's interesting because they have something to explain. So transparent. It seems that part transparency does not exist. So once government requires you some transparency, you don't have the choice of being partly transparent. So that means, despite the table you showed, in which you must only disclose some information, if only this information is disclosed, you may have a damage in your image. And the example here of Barclays shows this quite well. So Barclays had to give more information in order for the public not to get the minor information and believe that they are bad citizens here. So they must explain why each number, why the numbers are there. I enjoyed this example to show that despite our belief that CBCR would be, let's say, partial, quite, let's say, only some information, this is not true. Because of the public image of the company, more information must be disclosed, despite not forced by rules, forced by the public. So it's an either you're transparent or not transparent, but partly transparent, as one would believe by only reading the CBCR. Because I must say, Steve, when I saw your first table with the information, these checks for the information, said, well, this is minor information, this is not relevant, and so on. Suddenly you see, no, come on, this is not true, because this information, if only this information is given, you may have a damage in your image. And Barclays here is showing us why. So this transparency seems to be a path with no way back. I don't know whether it's good or not, but I did enjoy this table very much.
Yeah, and that's the funny thing is, if you have one, the public CBCR for banks doesn't have a fixed format, so you can present it any way you want. But you're right, Luis, that if you read the line in the middle, in 2019 we paid no UK corporation tax. That sort of is the neon lights you typically would have to manage your attention with the public interest and your contribution to society on, and then you get what is it, 10, 20 lines to explain something which is extremely complex in a very rudimentary way, that even people like us sitting around this call have a hard time understanding all the technical context on this. And this goes on with all the countries they look at. One of the drivers of the public CBCR also has been by publishing the CBCR, they need to disclose where they have legal entities, which apparently was not the case before in that level of detail. And by showing the reduction of legal entities in tax havens, that was sort of seen as a measurement of less leakage. Is that always the case? I don't know. If we look at this, we don't know. That's hard to guess on a simple information like this where something is wrong. Everything could be right here, but you don't know.
You mentioned
so may I say?
Sorry, just say, since he mentioned people like us read this text and begins to make further questions. So why is it that the Barclays has dividends which are not taxable, but the pension funds are fully deductible? So why is there no match between both of them? So there's a problem in the system here. So they should not deduct expenses if their revenues are not taxable. So this is something which one begins to ask more.
Yep, I think each piece of information triggers another series of questions. Kuntal, just a short remark on your side, because I'm conscious of time. I seem to have run out of time.
Sure, just a very short remark. The way Louis mentioned about the system. So if you look at Indian system, you will never have a scenario where an Indian based multinational will pay no tax in India. You will have to expect that company to pay tax in India. Not only the corporate tax, if because of whatever reason the book profit is provided in the financial statement, the company will have to at least pay minimum alternate tax. So he will never have a situation where Indian corporate will have such statement that it has paid no taxes in India.
Yeah, but I think this is an example, not necessarily the example, but an example how much tension there seems to be in a simple reporting like this. And we thought it was, as you rightfully say, the tick the box, Luis. It seems like, okay, I can deal with this. But when you see it in real life, it looks quite different, and it triggers tension. We move to the next slide. So shifting to the extractive industry. So mining companies like this is the reflection of Rio Tinto. We just took 2 of their pages from their public disclosure on where do we pay tax and how much tax do we pay. So basically, they give the income and the taxes they pay on royalties, on corporate income tax, but also employees, payroll tax, even harbor tax is included in this reporting, and it's been signed off by an accountant. So there's a full validation. Basically, it does give you the revenue and the geographical allocation of the revenue. It gives you the income reported in the territories, and it gives you the taxes. And as you can imagine, you can then find out through the internet, you can find out the geographical spread of the people, where people people activities do typically under the BEPS generate a profit. So you can make a pie chart based on this public publication and start doing outlier analysis as if you were having access to the full CBDR information. Obviously you don't, and you don't know the background, but this is a good approach where the CFO of Rio Tinto is also very much in favor of this and has been pushing this. While if we move to the next slide, like to give you a touch of flavor of a case we run last year. We called it the Harvard Business Case Studies on famous court cases. This was the ATO, the Australian Tax Authorities, challenging BHP, one mine with headquartered in Australia, and Rio Tinto, another mine headquartered in Australia. So this was a little bit the public hearing in the Senate where BHP and Billiton and Rio Tinto disclosed that they were being audited by the ATO. Basically, the corporate affairs and group tax of BHP said, well, you know, we're not interested in a public domain interrogation and disclosing everything. By the way, we have commercial sensitivity in place. And as a consequence, the head of group was sort of also refused to answer certain senators' questions which were raised in this public domain. If we go on the next slide, then we see the Rio Tinto, similar structures. I think Rio Tinto and BHP run Singapore hub operations. And the ATO asked the question, well, what is the substance in Singapore? And can we, in the typical ATO type of interrogation way, can we have all the commercial people sitting around the table telling all to us the way they run their daily work, so we can find out who is closest to the single version of the truth. Rio Tinto was very open and transparent as it has been producing this annual report already being also certified by the accountant. So for this presentation, I can't really go into the video. I would have loved to, maybe at a later stage if we have some time left, and we can also show Chris Lynch his interview, why he thought it was very good to be very transparent. This is the big question: does transparency always pays off? Well, the numbers who we made fat in fonts are not necessarily comparable because there's different years, different interest at stake. But the BHP agreed to settle for an amount a couple of years, and Rio Tinto did also settle for a certain amount. In both cases, the mining company said they were doing nothing wrong because they were running a pricing arrangements which were in place at arm's length. So this was all pretty much a level playing field between BHP and Rio Tinto. Yet that their attitude towards the communication with tax authorities, in this case a very aggressive ATO, seemed to be different. And not only the ATO, but also the parliament had these senators doing these public interrogations was obviously a exposure in a country like Australia, which is big on mines. Everyone had an opinion on what is the definition of a good corporate citizen. Is that the one who answers all the questions, or the ones who tries to get around it? So this is basically what is the big question mark. If we and we've done that last year in November, we went through the full BHP and Rio Tinto case, and we tried to simulate the decision-making process in the boardroom with the input of the tax team, what to disclose and what not to disclose. So a Harvard business case typically runs you and simulates your part of the board of BHP and Rio Tinto and run this decision-making process. In this particular case, on the tax aspects of your trading flows through Singapore to China. And then the big question comes up, how much stars on the horizon do you get for being a good corporate citizen? Is it 5 stars? Is it also 5 stars on transparency? And what does it mean in terms of financials to pay? So this is just a introduction of what does good corporate citizenship mean. If we move to the next slide, if there's any next slide. Yeah, this is a for you to read on a separate occasion. But this is a checklist for boards of directors of New Zealand companies, where basically the question is, okay, you have a corporate, who is then accountable for enhancing that transparency as a good corporate citizen? So this is a checklist the New Zealand government put up, where they said basically it's the board together with the delegation by the board to the in-house tax department. That's who we talk to, but in legal terms, only the board can represent this company, and the board should be fully aware and make decisions on this, I could call it checklist for boards of directors of New Zealand companies to be, from a governance perspective, be fully on top of how much transparency do we weigh against the taxpayers' rights like privacy and confidentiality. Conscious of time, maybe Luis and Kuntal, some closing remarks from your side?
Yes, maybe talking about your last slides and this information, whether the company is being audited or not, whether it's been questioned or not, I think this is also maybe too much information sometimes, because being audited or being challenged doesn't mean that you need to pay taxes. So in principle, companies are audited and they publish their balance sheet. In their balance sheet, there is already, let's say, an auditor will check whether there is a risk of tax assessment or not. But the questions, I mean, I'm seeing maybe too much transparency, and this may be also misleading. What's the point whether I'm being audited or not? What's the point whether the tax authorities believe that something might be wrong or not, if I have also the right of the due process of law, I have the right of bringing my arguments against it. So I found that we are talking about too much transparency. So there should be a level of transparency which would be required for tax governance. I saw the wording here, tax governance, which is important.
Okay, thank you very much.